dinner tonight. So before we dive into the exciting stuff, here's a little disclaimer. So I would like to remind all of you that everything we discuss today is for general information and educational purposes only. So it does not constitute to any recommendation to make any investment decisions. They are just some good insights to guide you. Now let's start with a quick introduction about our company, Phillip Capital Sendirian Berhad. We have been around since 1995, and some of you may remember us as Phillip Futures. However, over the years, we have expanded our products and services, and that's why we have decided to rebrand ourselves as Phillip Capital. We are also an active participant in both Bursa Malaysia Derivatives and Bursa Malaysia Securities, and we hold a capital market services license. Speaking of that, we have offices nationwide. Our headquarters are located in Kuala Lumpur, and we also have 11 Phillip Investor Centres across Malaysia. So if you ever have any questions or need advice, feel free to drop by the nearest branch. We'd love to help. I also want to share on something we are really proud of. So these are the Bursa Excellence Awards that we have received in the past few years. And we were very honored to be awarded as the champion for the best retail derivatives trading participant and the second runner-up for the best overall derivatives trading participant in 2024. And while we are proudly Malaysian, we are also international. As you can see on the map, we are present in 15 countries. This global reach means we can offer a wide range of trading products. For example, we have access to major exchanges like CME, CBOT, COMEX, and NYMEX in the US, plus exchanges across Europe, Hong Kong, Japan, Australia, Singapore, and of course Malaysia. So here's the cool part, because we are all connected to these all exchanges, so you can easily trade both local and foreign products on the same platform. Now let's talk about what Phillip Capital can offer you. We provide a one-stop solution for all your trading needs. Our products are categorized into three main areas. First, we offer futures trading, which includes diverse markets like index futures, agricultural futures, metal, energy, and interest rates futures. For those who are interested in equities or stocks, we provide access to Malaysia shares, US shares, Hong Kong shares, Singapore shares, and Australia shares. Additionally, we also offer contracts for difference, which includes both local Bursa and US CFDs. So why should you choose Phillip Capital as your broker? Well, we are an award-winning multi-asset broker, and we offer 24-hour broking and execution support. That means if you run into any issues with your trades, you can always reach out to us, and our team of dealers will be there to assist you. We also provide advisory services and send out daily market updates, keeping you informed of the latest trend. Additionally, with our global coverage, you have access to a wide range of products on one seamless platform. And the best part, opening an account with us is completely free and there's no platform fees. We also believe in the power of continuous learning to stay competitive in the market. So to help you improve and adapt to the changing conditions, we offer free one-to-one coaching sessions and organize free seminars and webinars like the one you're attending today. So our one-to-one coaching includes personalized guidance on futures, CFD, and stocks trading, along with platform and charting system training. So if you're interested, simply reach out to us and we'll be happy to schedule a session at your convenience. So other than that, we also host a weekly market calls every Monday at 11 a.m. where our analysts share valuable market insights and updates. We also have live counter technical analysis every Monday at 8 p.m. where we discuss weekly trends and potential entry and exit levels. So these sessions are a great way to stay ahead on the market. You can find it in next slide to secure a spot. And yeah, we love to keep things changes, so which is why we regularly organize different events. So if you are worried about missing out an event that interests you, you can just scan the QR code and check out our upcoming events. Or you can also visit our website at philip.com.my for the latest updates. And if you are interested and ready to start trading, we have made it easier than ever to open an account with us. So whether it's stocks, futures, or CFD trading, you can enjoy a hassle-free online account opening by scanning the QR code. Plus, we offer free trading platforms for our investor, making it even easier to start your trading journey. And now let me introduce you to some of the trading platforms we offer. First up, we have our in-house Philip Nova platform, which is designed specifically for futures trading. So this platform comes with over 90 technical indicators, which can really help you in analyzing the charts. You can place your buy or sell order directly from the chart as well. So on top of that, Philip Nova also gives you access to live market news and also the ability to set price alerts. So you will never miss an opportunity. And if you are curious and want to try it out, you can scan the QR code to get a demo account. It's available on both App Store and Google Play, so feel free to explore it on your phone. And now let's talk about our live charts, which are powered by TradingView. So you can actually trade both local and foreign products under one account with access to 17 global exchanges. So whether you are trading locally or internationally, we've got you covered. And of course, we offer 24-hour broking and execution support for all your trading needs. So for those of you who are into stocks trading, so we are using Poems Global, which is a platform that's equipped with all-in-one watch lists, exchange top 30 movers, and powerful stocks analytics. So it's perfect for both new and experienced traders. And if you have been keeping an eye to the US market, now is your chance to dive in. So you can invest in US shares and ETFs with us from just 0.02% or a minimum of 3.99 US dollars. You also get free US live market data with no platform and custody fees at all. It's simple, affordable, and smart. And lastly, for CFDs, we've got Philip CFD Trader, which is an ideal all-purpose trading platform with a user-friendly interface and advanced order type. So this is designed to meet the needs of traders. And now let's talk about some promotions we have for you. I would like to highlight an amazing opportunity for those of you interested in trading Singapore shares. So if you have been considering expanding your portfolio to include Singapore shares, now is the perfect time because we are offering this special low rate of just 0.1% available from 15 April to 15 July of 2025. So on top of that, you will also enjoy free level 1 market data when you trade with us. So don't miss out this opportunity. You can scan the QR code for more information. And now for something even exciting, let me introduce this promotion for those of you into futures trading. You can now trade SGX Asian Index futures covering markets like Singapore, China, Taiwan, Japan, Indonesia, and Vietnam with commissions as low as 1.88 US dollars. So this promotion is valid until 30th of September. And if you are already a Philip Capital client, you are automatically in. But if you're not with us yet, no worries, you can just open an account now and gain exposure to the SGX markets at this amazing rate. And also, we've got something exciting lined up for you. During our Q&A session later, we'll be giving away 4 touch and go reload pins worth 50 ringgit each. So make sure you stay tuned and pay close attention to the session because you might walk away with 50 ringgit tonight. And before we dive into our topic today, I would like to take a moment to introduce our speaker, Mr. David Ng. So Mr. David is currently a full-time proprietary trader with Iceberg Sendirian Berhad, a local proprietary trading firm based in Kuala Lumpur. And he has done extensive research and is well-versed in the commodities and indices markets. He currently trades the Malaysia Index and crude palm oil futures market, and he holds a CMT designation as a chartered market technician. Previously, he led a young and dynamic team with a prominent local broker to promote futures and derivative instruments to the Malaysian public. And he conducts regular public seminars and webinars on topics relating to futures trading and has aided individuals in starting their trading journey. In addition, he also provides frequent market commentaries to local media like The Star, Business Times, and The Age in that role. So let's welcome Mr. David. Hi, Mr. David.
Yeah, hi. Thank you, Charlie. Not sure. Are you able to hear me?
Yes, I'm able to hear you.
Yeah. Okay. I'm just going to share my screen now. Just do let me know if you can see the slides as well.
Yep, we can see the slide, but not at full screen. Maybe you can. Yeah, it's good now.
Okay. Okay, thanks. Thank you, Charlie. Thank you for the very kind introduction. And definitely thank you for the audience for joining tonight. Hopefully you had a good dinner session. Just before I start, just like to take this opportunity to also thank Philip Capital and CME Group for inviting me to talk on today's topic entitled, cracking the code: how to trade agriculture futures, especially on a CME exchange. When you talk about commodities, there's a lot of categories. You talk about energy, you talk about a precious metal, which is gold, is getting very hot right now. And I think specifically for today's session, we're probably going to touch more, or rather, diving more into the topic of grains. So when you talk about grains, it's mainly talking about corn, soybean, and wheat, the three major grain products that's listed on a CME exchange. So as usual, I think as just want to put it out. Any opinion that's presented here today is basically based on my own personal opinion. It doesn't reflect any opinions, whether it's from Philip Capital or whether it's from CME Exchange. So any opinion that you hear is basically my own personal opinion. Now, I just want to emphasize this as well. If you are new to the futures market, dealing with futures is a derivative instrument, so it does involve a lot of risk. So make sure you are well informed. Source the right information. I believe Philip Capital, representative from Philip Capital, can able to help you in this regard. And I think dabbling in futures market does involve a lot of risk. So make sure you are well equipped, and make sure you have the sufficient knowledge before you actually start your journey into futures trading. So I think it's a net in the next 45 minutes or an hour or so. This is what we're going to cover. I think when you look at commodities in general, why commodities tend to display certain tendencies. I think because of the nature of commodities itself. If you have been trading palm oil, for example, which is a key product in Malaysia, if you notice that it's always a period, or there's always a seasonal pattern that is playing around, or between a certain period of the year. So, for example, if you take palm oil as a leading example, there's always a period where prices tend to be weak, and usually that coincide where supply or production tend to rises, or stock levels tends to rise. And usually during those periods are what we call low season periods or low price periods. We can see that in also in US agriculture. The major difference is that when you trade US grains commodities, especially whether it's corn or soybean, you must understand that these two crops are what we call annual crop. So there's always a planting season, there's always a harvesting season in the market. So every year we have a period of planting, period of harvesting. So therefore prices fluctuate within those periods. Unlike CPO, palm oil is a very pre-annual crop. You plant a palm oil tree, you can last you at least for 20, 25 to 30 years. So there's no such thing as you plant for the next 3 months, you harvest for the next 3 months. It doesn't work that way. So when you do US agriculture, this is the major difference that you have to understand, that when you do corn or soybean, it is I think it is more important to understand the seasonal tendencies that's in play, and important to understand these are all annual crops. So we will dive in a bit more later, especially when we look at crop calendars. Now I think other than that, factors that actually affect grain prices are usually your basic economic, demand and supply issues. So demand and supply, it is very instrumental. And whenever you have a oversupply situation, that's where it tend to drag prices lower. So we will cover that in the beginning of the session. Now I think one of the key things when you trade commodities is that we always look at a seasonality that's still in play. So if you look at corn or soybean, there's always a period where prices tend to be weaker, and there's always period where prices tend to be stronger because of whether it's because of supply and demand dynamics, or whether it's because there is a certain season that is always in play for a particular commodity. Last but not least, I think the second session we look at certain strategies that you can use, especially when you look at technical reading. I think if you are using trend strategies, Heiken Ashi is a very good tool for you to look at trends, especially when you look at the type of candles that's being used. So this will be covered in the second session. Now, if you just look at the major factors that affect grains market, I think the main key thing is always looking at the demand and supply in aggregate. So you can't run away from basic economics. If you want to study why prices are trending lower or trending higher, especially for a particular commodity, we always look at the demand and supply. So whenever we have a situation where this particular commodity is oversupply, you tend to see prices tend not to do well. Vice versa, you tend to see a particular commodity having a short supply and demand is very strong, you tend to see prices for that particular commodity tend to do well. Now, so what's happening in both corn and soybean market right now in US is that we have an oversupply situation in both markets. So therefore, you tend to see why corn prices and soybean prices actually been quite weak for quite some time. So demand and supply is a crucial thing, especially when you're trading the US grains. Second thing is always seasonality, as I mentioned earlier. So if you look at corn and soybean, now you're entering into key planting season, which usually starts around early April and ends right until end of May or early June. So these 2 or 3 months are very critical. Why is that critical? Because during planting season, if there's a bad weather effect, it can actually really rise prices, and it can either make prices rally or it can actually slump prices down. So it's very important that we understand the crop calendars carefully, especially when we try to understand how the corn and soybean market behaves when it comes to the crop calendar. Now, I know trading grains, trading commodities, as how we trade CPO palm oil in Malaysia as well. There's always report that we can always base on. So, for example, in Malaysia, if you're trading a palm oil market, we always have this what we call Mandi Malaysia Palm Oil or MPOB report that's come out quite frequently. Same goes if you are doing US grains, there's always this monthly report which we call it World Agriculture Supply and Demand, uh, or in short WASDE, and those reports are very crucial. So that will tell you whether how much is the supply, the estimate of the supply, or rather, and also the demand perspective. So these monthly reports are crucial. Now, if you have a situation where the report indicates to you that it's an oversupply market, suddenly there is extra supply coming to the market, usually you tend to see prices react quite negatively. So if you are a trader, you want to trade, especially are trading in US grains, you have to be very careful of this report release days, because during those days you can clearly see that whenever reports are out, prices tends to have an impact on it. So if you are a trader trying to avoid those days just because the volatility of the market, you should be careful of when those reports are released. So WASDE has a schedule of report release across every month, and it's a monthly report. It's a very crucial monthly report. So prices tend to react in anticipation of the report release days. So be mindful if you are doing US grains, you really have to watch out on the report days. Now, besides the World Agriculture reports, there's also other reports like planting reports, planting intention. These are all also very crucial, especially when you're in the planting season. Same goes when it goes into harvesting season. Those reports are also very crucial. So these are the key things that you really need to look at when it comes to report. Now, if you are a trader, these reports will have a significant impact, because eventually, if the report comes out, slightly above or below estimates, normally you tend to see a bit of reaction in prices. So that's where it gets a bit tedious in certain ways if you are trading the US agriculture. Now, other than that, other factors that can actually influence prices are price of movements of close substitutes. Now, in this regards, usually we talk about crude oil, because corn and soybean are also important feedstock for biofuel. Now, when you talk about biofuel, everyone is talking about green energy, and whether it's talking about ESG and whatnot, there's always a demand for that. So as long as crude oil price is substantially higher, and there's a profit to be made for biofuel producers, definitely corn and soybean demand is going to be high. But however, if crude oil price is going to stay low, normally there's not good enough margin for biofuel producers to produce. So therefore, the demand for corn and soybean is going to be get affected. So crude oil price dynamics are very is heavily linked to how the biofuel demand, especially for corn and soybean. Now, geopolitics is another big concern. Now, as we enter into Trump 2.0, there's obviously a lot of uncertainty. Trump 2.0 ushering definitely a lot of uncertainty in terms of policies direction. So, when it comes to geopolitics, it can really move markets, and that's where we really need to be careful. Last but not least, weather extremities. Now, weather is an important and it's very variable element. When I say variable in the sense that you can suddenly, especially when you enter into a key planting period right now, normally if you start to see good weather, normally prices will tend to be soft. But when you start to see weather becomes bad in certain key areas, that's where you start to see price start to spike up. So during this crucial period, it's important for us also to look at weather. Now, weather reports are very hard to interpret. Even I myself will find it very difficult and challenging to interpret so many of these reports. But do keep in mind, I think weather is an important play, especially when you're entering into key planting seasons and also harvesting seasons. Now, I'm just going to share with you on how we see the demand and supply. I think key thing is that besides looking at demand and supply, the important areas to take note of is looking at where the growth is coming from. If growth is not doing well, there's always the economic growth is not doing well. There's always a concern on how the demand is going to play out. So if you just look at where things are heading to, especially early part of this year and going into the second part of this year, really, I think things are not looking as good as it is. If you just look at where projections are coming from, we started off this year very positively because I think in anticipation of Trump, everybody got hyped up. But once Trump's come into the picture and start putting his policies in, I think things start to change. So in terms of growth projections, I think people are slowly looking at next, probably second half of this year is going to be quite tricky. So therefore, that's going to have an impact in terms of the overall demand or general demand for the economy. Now, if you just look at commodity prices, where we are right now, we can see the prices are actually climbing, inching higher. Now, this is basically a chart. It's basically on Thomson Commodity Index, so it tracks some of the major key commodities. It's not only for grains; it's actually mainly a basket of commodities, mainly crude oil, precious metal, and whatnot. So you can see that generally commodity prices actually been inching higher. Now, this is going to be a concern going forward because I think with prices going higher, commodity prices going higher, it will create, or rather, it will inflict a lot of inflationary fears. And when that comes in, that usually be triggering interest rate decisions in US. But what this is telling us is that commodity prices, despite we're seeing certain pockets of commodity not doing well, but generally overall we can see that commodity prices is actually climbing higher, and that's if you compare to pre-pandemic levels, we are almost pretty much back to those levels. So crucial to watch whether the next couple of months and weeks whether commodity prices can still stay where it is. Though this is happening despite the economy growth is slowly starting to slow down. By right, we should start to see demand for commodities should be dwindling, but we have not seen that. So it's important to watch because this will have an impact in terms of especially your central bank policies going forward. Now, recession fears, I think this is a major concern, especially for the early part of this month, especially before the intensity of between US and China trade war actually start to begin. But really, I think after since there's 90 days of reprieve between the US and China, we start to see the recession fears starts to ease. Now, whether that will translate to better demand going forward is still a question. Keep in mind, US is a very large economy. China is also a very large economy. And US, the major export product, it is commodities, it is your grains. It is not about electronics, although electronics plays a big role, but the grains market is the number one US exports product. So no, I think US, being US, Trump definitely wants to strike a deal with China in terms of agriculture products. I think that is still yet to be seen. If that really happens, you definitely going to see price movement in the major US grains market. So that's something that we really have to, if you are trading the market, we have to watch out for, because that's something that is geopolitical element can really influence prices, especially for this year, or in fact during the Trump 2.0 era. Now, I'm not going to touch too much on U.S. economy, because if you just look at where the global projections for economic growth in totality is that second half is going to be weaker. So now we are going into the second half of the year. We should expect things to start to slow down, not because of the tariff that's kicking in. Despite there's a reprieve, tariff is being lowered from such a high levels. Still, there's definitely pressure that's being felt across different industries and sectors. So really, I think going forward, things are not looking so optimistic as how we started the year, and I think that will have an impact when it comes to the demand for commodities in general. Now, this is what I mentioned, the crop calendar. Now, if you are trading the US grains, this is a calendar that you really need to focus on. So in US, if you are doing US corn and US soybean, you must take note that April to June is usually your planting period. So these are right now is the period where a lot of farmers in US are going for planting for corn and soybean. Now, they will start harvesting usually at the beginning of September, right until November. Corn is slightly later. So these are the periods that's crucial. Now, as I mentioned earlier, right now every week they will have a planting report, and usually that would indicate to you the planting progress. Now, during this report release days, usually market tends to gyrate a little bit, because if the planting report comes out lower or higher than estimates, normally prices will react. So planting seasons and planting reports are very crucial during this point. Now, same goes for harvesting. Normally, when we go for harvesting in US, those harvesting progress reports are also very crucial, because that will indicate to you, how the supply is going to play out. If the harvesting cycle is bad, normally you expect supply is going to be bad, and usually that will push prices higher. So, if you are trading US grains, you really need to understand the crop calendar carefully, because that will eventually impact the seasonality in terms of price impact. Now, if you look at Brazil and Argentina, the planting and harvesting cycle is completely different. So, Brazil and Argentina will start harvesting during this time, which is in reverse to the US guys, because if you look at it, one is the northern hemisphere, one is southern hemisphere, so they run in opposite direction. And when US starts to harvest, they're actually starting to plant. Now, why Brazil and Argentina is such a significant importance in this crop calendar? Because they are a very big player when it comes to the soybean market. So if you are doing soybean, not only you have to pay attention to US, you have to pay attention to the South American guys, especially Brazil. In fact, the largest soybean producer in the world is not US anymore. It's actually, in fact, Brazil. And second to that is US, and third is Argentina. So Brazil is a very significant player. Unfortunately, they not have a liquid market yet when it comes to soybean futures as a benchmark. So therefore, US soybean futures is still a good benchmark for a lot of producers out there. These are some of the report schedule I mentioned. The always key report to watch out is the World Agriculture Supply and Demand, the WASDE report, which is come out on monthly. Now, weekly basis usually is the crop progress, which I mentioned earlier, the planting reports. That is also very significant, because during this time, planting season, if there's a slack or there's a hindrance in terms of the planting progress, normally that will translate to higher prices. So you have to watch out. Then other than that, you have the quarterly, the stock reports, you have the half yearly acreage reports. So all these reports are quite evident and it's important. So if you are trading the market, you have to take note when are these report release dates, because eventually that will affect market as well. So going to the grain supply and demand dynamics. Now, if you look at US corn and US soybean, corn is slightly on the bearish side, given that US farmers' intention to plant corn is actually very aggressive this season. So 2025 planting season showing you that it's going to be a record US corn production. Now, this is assuming weather is favorable, and down the road, there's no weather extremities. We should see US corn production to be quite abundant in this 2025 season. Soybean, on the other hand, is going to be projecting to be slightly lower, because I think the intentions for US soybean farmers are they intend to plant more corn instead of soybean, because corn demand higher prices. So normally there's adjustment in that, but really I think if you look at it, corn is expected to be quite bearish because of the record production in the US, and soybean seems to gain a bit more ground because production tend to taper off this year because the intentions are smaller. Now, when it comes to stock levels, you can see that ending stocks, because of the abundance in production, we should see US corn stock levels will start to rise. Soybean, on the other hand, will start to decrease because production seems not to be doing well. The intentions of farmers are to plant more corn rather than soybean. So therefore, soybean production may take a hit or impact. That eventually that will translate to lower stocks or lower ending stocks for the soybean market. Now, I mean, if you look at parametrics, fundamental parametrics that's worth to watch, especially you are trading the grains market, is to look at stocks to usage ratio. Now, this stocks to usage ratio is key because the lower ratio or stock to usage ratio you have, it does indicate to you that the commodity is actually under supply. When you have a high stock to usage ratio, it does tell you that commodity is actually a bit more oversupply. So despite corn, US corn is going for record production, the stock to usage ratio, this is in terms of world, it is still quite on the lower side. So that tells you generally corn, you can't be too bearish because you just look at where other countries production besides US is actually not that good. So, and the demand for corn is still quite robust. So that tells you why the ending stocks to usage ratio is actually quite low at the moment. But it's different story for soybean. Soybean is still quite pretty decent, although the trend is showing to you that the stock to usage ratio is coming down. But the absolute level is still quite elevated. So it does tell you, people are actually demanding less of soybean despite the production coming down. The demand for soybean is actually quite weak as compared to the demand for corn. So stock to usage ratio is an important parameter to look at if you are really trading a grains market, because that will probably help you to gauge where the market is oversupply or undersupply at that point in time. Now, soybean, is this slightly different story when you look at the South American players. When I mentioned the South American players, is in particular the Brazilian market. So Brazil soybean, as I mentioned, is the largest. They have overtaken US for almost more than a decade now. So they have taken the number one position in terms of the largest producer in the world. So Brazil every year has been a record year when it comes to soybean production. There's obviously controversial that link to that. A lot of reports says that they're clearing forests just to plant soybean because that's marketable product for it, and the margins are attractive. But having said that, if you keep producing and there's not enough demand to meet the excess supply, prices will just have to adjust. So soybean, because of the South American players, especially Brazil, have been ramping up production, it's going to put a dampener in the overall soybean prices. So the fundamental, you can't be too bullish on soybean because the South American guys, especially Brazil, has been producing year on year higher amount of soybean with higher area planted areas. So that's really a concern. So if they continue with that trend for the foreseeable years, I think that's going to be pressuring prices going forward. Now, so this is what I meant by crop planting report, which is out on weekly basis. So you can see that both US soybean and corn is actually quite in line. There's nothing much to tell about the market to say that suddenly there is a certain a bullish report because weather took a toll on the planting progress. So far, it doesn't indicate that. In fact, they're actually quite in line with the progress. Now, soybean is slightly ahead. That's why you can see that soybean has actually been quite pressured, but corn on the other hand is slightly slow. The planting progress is slightly slower than average. So therefore, why corn prices actually been gaining strength for the past couple of sessions. So right now we are in planting season, it's crucial period. So any weather extremities can actually change the whole dynamics of the market. So you have to be very careful when those planting reports are out, whether it's between estimates, below estimates, or higher than estimates. Now, this is what I meant. I think the South American supplies are slowly gaining market share. I think both Brazil and Argentina combined, they're easily more than 50% of the total soybean supply to the world. US used to be quite a significant player, but they have lost their position. So despite that, I think people are still looking at CME soybean, grains as a price benchmark, despite US no longer as the number one producer. So I think really going forward, will Brazil prices be a significant influence to the US players? I think it could be, but I think that will really take a bit of time to really materialize. But having said that, I think US market itself is actually very liquid. It comprises a lot of different players that is in the market, and that gives a bit more robust. It makes the market more robust for participants as well. So, US will continue to be a powerful, or rather a strong determinant when it comes to prices, despite their losing their position in terms of the world largest soybean exporter. Now, so that's on supply. If you just look at demand, again, it's always US and China. The world largest demand for soybean, uh, you know, definitely comes from China because of the size and the population. So, China itself is a very large player in the US grain space. In fact, I think they are the number one buyer for now. So, if you just look at how China has progressed in those days, US pretty much export all its produce to China, and China in on the other hand also import majority of their grains from US. But right now you can clearly see the dynamics shift. China no longer depend on US soybean anymore, so that's a pretty it's a pretty significant change. And in fact, they're relying more on the South American supplies. But now, if you just look at a crop calendar, there's always a period where they need the US supply because Brazil can't produce all year round. They need whenever Brazil goes for harvesting, the US will come in to come and supply the market. So it's always a twofold, that is contributing to China. So China, in other words, still needs the US, supplies. But I think the dependence on it is getting lesser and lesser year on year. So let's see. I think this Trump 2.0, probably they might work out a deal to put more emphasis on the US soybean. It could work that way, but do watch out. I think geopolitics is definitely going to influence prices as well. So this is what happens in the phase one. You can clearly see US greens was a major bidding cut for Trump between the US and China trade deal. But I think ultimately, after after Trump lost the first election, I think the trade deal didn't really materialize. Whatever they had projected to deal with, they didn't really manage to hit the target. So this time around, whether will they reach another new deal, that still begs the question. But I think we can't really. I mean, we have to acknowledge the fact that China is a very significant player for US grains, and China holds a trump card. So if you are trading the market, you really have to watch out news on the US and China trade war, trade tariff that's going on, because eventually that will have impact on prices. China is a very significant player when it comes to US grains. Okay, so again, this is just to show you, why China is growing importance for the US market, for the US greens. Keep in mind, US greens production is not slowing down. You look at the trend, especially for soybean, it's actually looking at higher areas of planted, even for corn also higher areas of planted. So production is actually, expected to produce even more in the next couple of seasons. So with excess supply, you definitely need demand coming in, and I think that's only one equation that it needs China. So this US and China trade deal is definitely something to watch out for if you are trading on the grain market. Now, so this is again just to highlight, US has a lot of commodities, but the surprising thing is that the number one commodity that's being imported by China from the US market is actually soybean. So soybean is a major trump card. So anything that's got to deal with any of the trade deal, soybean will have to be in the picture because soybean is a major commodity. And if you just look at the demographics of supporters for Trump, you can see a lot of them are farmers. So really, if Trump wants to gain popularity, he really needs to take care of the farmers. So I think soybean is one of the categories that's worth to consider. So you are trading a soybean market, is an area that you have to watch out carefully, because if you ignore the political news or the trade wave, it can really disrupt your trading expectations, because eventually if there's a trade deal being in progress, it can really make soybean prices move in certain directions. So that's something to keep an eye on if you are trading the soybean market. So this is just to emphasize the point. Really, I think if you talk about largest producer, it's no longer US. You talk about largest demand, whether coming from China, is also no longer the picture, because China now starts to demand more for the South American supplies, mainly from Brazil. So really, I think US is in a very precarious situation. They are losing their market share. Eventually, I think that's a point of concern in the medium term. But what is important to take note is that it is vital to understand how the South American guys are going to play out. Whether Brazil is going to keep producing more. From the trend, it looks like it's going to be the way. And in the next couple of years, I think Brazil is going to dominate the market with a lot of supplies. And if they don't get enough demand or sufficient demand for that, that can really tell how prices will go. So really, it's important to see how Brazil will try to tame its production, because every year is a record production. They have never seen a single year where they actually see a slower production. If it does happen, usually it boils down to weather. So that's an equation that you really have to watch out, especially for the South American supplies. Now, not going to touch too much on China, because China is definitely a very large economy. If you talk about grains, they are actually the number one buyer for the US grains. So anything to do with China, you have to look at the economy of China, the prospect of the economic momentum. Now, as long as China is still dealing with its own internal affairs, especially in the internal domestic weakness, is definitely going to translate to weaker demand for the US grains naturally. But what is important is that China now has a new supplier, which is the South American guys. So there's always a less dependence on the US producers. So eventually, I think that may put a pressure, and that's where you start to see there's starting to see there's a differential between the US FOB prices and even the South American FOB prices, because ultimately that's affecting the market dynamics as well. So China is putting a lot of reliance, no longer putting less dependence on US players and putting higher reliance on the South American players. Now, US-China trade war, because of the temporary 90 days reprieve, we can see that prices for both corn and soybean actually been doing very well. Now, as long as, keep in mind, it's only 90 days, it's a 90 days of short window. What happens after 90 days? It really begs the question. So hopefully within these 90 days, they could really firm up a concrete deal. And in relation to the agriculture space, and if that does happen, you tend to see prices will be on the move. So I think that's an area that we have to watch out, especially during this 90 days reprieve. Now, since we talk about soybean and corn, I think it's also worth to mention about soybean oil. Now, soybean oil is obviously a close relation to palm oil. Now, whenever you see soybean production increase, you should expect soybean oil production to also increase, because it's a byproduct of soybean. Because the soybean, usually the byproducts are the meal and the oil. Now, soybean oil is mainly used for consumption. It's also used in the biofuel segments. What's important is that because palm oil is still the number one vegetable oil that's being produced and consumed around the world. But given the fact, I think last couple of years, especially both Malaysia, Indonesia, the use of palm oil starts to decline quite rapidly. Usually that's a sign of concern. But having said that, I think soybean oil is slowly gaining market share in terms of the production itself. So recent years you can see a lot of US factories actually expanded capacity for soybean processing. So that explains why soybean oil has actually been doing quite firmly well in the past couple of years, because you can see that there's a lot of extra capacity coming to the market, and there's also extra demand for it. Now, I'm not saying that eventually soybean was going to overtake palm, given the fact that palm is the most productive oil seed that you have in the market for now. So because of the productivity, palm oil can still dominate. But having said that, soybean oil productivity has also been increasing since the past couple of years. So it's really a neck-to-neck race to see who can produce more. But eventually, because of the nature of oil palm seeds, normally because the productivity of oil palm is definitely much higher. So eventually, I think there's a still gap between the palm oil and soybean oil market. But given the next couple of years, it could be a different picture altogether. As long as countries like US and Brazil keep planting soybean, the soybean oil production is going to increase quite dramatically. Now, if you look at soybean oil, again, the statistics are usually, if you're trading the soybean oil market, you look at crushing report, which is published by NOPA. Now, normally those will tell you indicate the stock levels and the crushing activity. So when you have high crushing activity, that tells you there's generally more demand for soybean and usually produce more oil, and supply of soybean oil is going to be higher, and that normally will means lower prices for the soybean oil in general. So now if you're trading a soybean oil space, you have to watch out on crushing report, which is out on a periodic basis, and in those reports normally soybean oil will take a move. Now, if you talk about soybean oil, it is important to relate between soybean oil and palm, because they used to trade between the price differential between these two intercommodities and the product itself. Now, in most cases, in most instances, you can see that soybean oil usually trades as a premium compared to palm. There's a lot of reasons that's attached to it, because the cost of producing soybean is usually deemed higher as compared to palm. And the productivity of soybean oil is much lesser compared to palm oil. So therefore, it commands a premium in the market. But you look at it in general, the spread between the palm oil and bean oil spread usually on average been trading around $100 premium, which means bean oil usually trades as $100 premium compared to palm oil uh, on a per comparison basis. Now, there's a period of time where it actually breaks beyond the 100. I think in recent cases, because of Ukraine crisis in the early part of 2022, we see that spread went to as high as $800. But I think since then it retracted a lot. So right now you can see that the premiums are back to its long-term average, is about 100 to 150 US dollar. So it does tell you that bean oil is actually relatively more expensive compared to palm. And I think in that sense, there's if there's more opportunity for people to look at palm oil, which is deemed to be cheaper, eventually that will push up the demand for palm, and that will support palm oil prices. As long as this premium remains persistent, it's going to give more benefit to palm, because palm now looks cheaper compared to bean oil. And bean oil is running on a very different news flow in recent times, because bean oil, not only they have higher production activity, which means higher production, but I think the biofuel segments are also trying to put pressure on the soybean oil prices as well. So if you are trading the soybean oil and palm oil space, the spread is a very good indication to which to indicate to you which particular market is currently overpriced and which particular market is underpriced. So right now you can clearly see that palm oil is slightly on the weaker end. Whether the spread eventually will narrow, it begs the question as to what fundamentals is going to shift the bean oil dynamics to further negative territory, or whether what fundamentals that can push palm oil back to its back, or push a rally into the palm oil prices to narrow back the gap. But I think right now, if you look at in terms of where the averages is in terms of the spread between both commodities, it's pretty much on the long-term average, which is about 100 to 150 US dollars. So it really begs the question as to what kind of fundamentals are we going to see with respect to each of the commodity in the coming weeks or months, because that ultimately will also determine the direction of the spread, whether eventually it will narrow or not. Okay. Now, I also like to compare this soybean oil and crude oil. You can clearly see there's the divergence happening. But I think in recent times, the strength on the crude oil market is probably going to propel or going to support bean oil prices because of the biofuel segment. So, biofuel or crude oil prices is an important element when it comes to influencing the grain prices, because the element of biofuel. So soybean and corn are an important feedstock for biofuel. So as long as crude oil price is high, there's always incentive for biofuel producers to use corn and soybean as a feedstock for biofuel. Now, if you are in a low oil price environment, normally that's going to be very difficult. So past couple of days, we've seen oil prices actually been hovering quite strong above the $60 mark. So that actually give a bit of breather to a lot of these biofuel producers. So therefore, that translates to better demand for corn and soybean. So over the past couple of days, we've seen that prices for these two commodities actually been rising, because in relation to the higher crude oil price that we're seeing in the market as well. Now, if you just look at bean oil, there's a specific news that's affecting the market, which is in relation to biofuel. So, the US EPA usually gives a mandate for total production for a particular calendar year. So I think right now they're probably proposing for the 2026 calendar year. Now, there's usually a target that the market expect, and once the mandates falls below that target or market target, normally prices will react. So right now, what happens is that I think the past couple of days, there's a still rumor that's circulating that the mandates are going to be lower, which means that there's going to be lesser demand of soybean oil in terms of biofuel production. So that's going to be a concern for the market. So therefore, we've seen how soybean oil prices reacted. From it went down from 52 cents right until to 48, 47 cents, per metric. So that's really a concerning factor. So if you are trading the soybean oil space, you have to look at energy as an important element, because that eventually will influence prices for the soybean oil market as well. Okay. Now, if you are trading the US greens, another important parameter to look at is the commitment or traders report, the COT report, which is out on a weekly basis. Now, I think one good features about trading US greens is that you are able to understand different reports and how it interplay into the market, or how it influence the market. So COT report is an important report to tell you or to measure to you, what are the net positions that's in the market. So just to highlight the perspective, when you have a market that is rising on trend in terms of price trend, but the net positions are or net long positions are declining, so it does tell you that a lot of a lot of this price rally is an opportunity for a lot of market holders or market participants to liquidate their positions. Therefore, that explains why the net position has actually been declining. So vice versa, in a rising market trend, in rising prices, you should be seeing net positions to be rising, especially a net positive position. So, COT reports will probably give you a better gauge, in terms of measuring how the sentiment of the market behaves. Especially if you see a trend that's in place in the market, it should be accompanied by rising positions, in the rising net positions in the net positions as well. If the net positions are not rising, especially during a trending market, usually it does tell you that a lot of people are not participating in that particular rally or in a particular downtrend rally. So really, this COT reports gives you an indication, it gives you a measurement. So right now, if you look at corn and soybean, off late, you can see that for corn, it's going to be a very bad scenario, because a lot of it started with a net positive position, actually beginning of the year. That's why corn prices actually been rallying above the $4 mark. But since then, it's actually tapered off, because I mentioned, people are expecting, because of high prices this year, calendar year 2025, a lot of people will be planting a lot of corn, and therefore the production for corn is going to be rising. So a lot of these net long positions are being taken off, and slowly people are turning to be more bearish because of the record corn production that is expected from the US market in this calendar year. Now, soybean is a slightly different picture. We started off the year in a negative position. A lot of people were not optimistic with soybean, because the South American guys are just keep producing every year record production. So they're afraid that Brazil record production is going to hamper US prices. So therefore, you can see that the net positions are negative. But I think that slowly changed in recent weeks. You can see that because the anticipation that US soybean is going to be weaker this calendar year is actually pushing sentiments into positive territory. So as long as net positions are rising, we should see a bit of price support when it comes to soybean market in the medium term. So that's pretty much on the fundamental aspect, looking at key reports, looking at what factors that drive prices, and really looking at certain periods where it's crucial. If you are looking at grains, corn and soybean, there's always period where it's crucial, especially during the planting and harvesting season. And last but not least, the important factors, the crude oil element when it comes to biofuel energy is an important factor that can also influence prices. So these are the few key dynamics, fundamental dynamics that or variables that really can influence prices. And as a trader, we just have to measure. We just have to be careful and measure those reports accordingly when those reports are being released. Now, I think the second part of this session, I'll be looking at how can we form a certain plan when it comes to trading the market by looking at trends in the market. So one of the ways is that you can look at overall the market trend by looking at where the trend is behaving, the price trend is behaving, whether is it above the moving averages or below the moving averages, or you can look at the position of candles, whether whether the candles are making higher highs or lower highs. Usually, if the markets are making higher highs, the market usually indicates to you it's an uptrend market. If it's a lower highs and lower lows, is establishing the market is going on downtrend. Now, if it is the highs and lows are pretty much fixated to a certain range, normally the market is sideways market. And normally in a trend market, in the sideways market, you really can't use trend trading strategy because that eventually will get you whipsaw across the board. So when the markets are moving sideways, there's no clear direction. No, you really can't use trend trading strategy, and you should be using other uh, more range trading strategy as a result. So there's a couple of ways to determine trend. One of it is using moving averages or looking at things visually. Now, to identify short-term market trends, you can also use Heiken Ashi candles. Heiken Ashi candles are just derivation of Japanese candlesticks. I'll just share with you later part why is it so useful when it comes to identifying short-term trends, because it is highly distinguishable as compared to Japanese candlesticks, which has a lot of pattern and configuration. Now, besides that, you can also use moving average crossover strategies, which is very common. Whenever you use two different periods, one shorter term, one longer term, whenever they crosses, normally it gives you an indication as to where the market is turning in a particular direction. Now, I think last one, when you look at trends in the market, once you establish as a trend in place, it's important to also gauge the strength of the trend. And usually that you can look at it using a DMI trend indicator, which I'm going to share on the later part as well. Last but not least, whenever we establish a plan, it is also important, or in fact, it's more important that you must have a way to establish your position with a stop loss measure in case the market go against you. Now, with markets so volatile these days, it is very important to make sure you have a plan in place to get yourself out of the market just in case the market move not in your favor. So, one, you can always use different tools to measure your stop loss level accordingly. I think one of the ways I use is to look at the average true range, the ATR levels, to measure your targets, your profit targets, and also your stop loss levels accordingly. So just give a snapshot, technical snapshot on some of the key commodities. So if you just look at CME soybean right now, you can see that majority of the markets or prices are hovering above the 50 and 200 period EMEs. So it does tell you that markets are slightly on a supported level, but it's moving on a sideways for now. So really, it's important to see whether can it hold above the $10 mark for the soybean market. It's crucial because that is a psychological level. If it does break that, soybean technically is going for a further downtrend. So soybean prices are still moving on a sideways market and supported well above the 1050 level based on the 200 period EMA level. Now, corn prices is slightly different. You can see that it started off the year very strong. In fact, I think it broke above the $4. It climbed to as high as almost $5 per bushel. But I think since then it's taken a toll because in anticipation that as we move into April, planting season corn will start, and I think people are expecting that this year is going to be a record year for corn. Now you can see early April we start to see a bit of strength because when the planting report starts, the started of the year it was actually quite bad because certain parts in US the planting progress actually been very slow. But I think that has changed. The planting progress has started to perform well in the past couple of weeks, and therefore that explains why prices actually been coming down. So corn prices are still on pretty much on a short-term downtrend. It's trading below both the 50 and 200 period EMA. So it's crucial if it does break. I think the first key level is to watch is the 50 period EMA. If it does break above that level, that's a sign that probably we could see a bit of technical reversal when it comes to the corn market. Fundamentally, it's still going to be bearish because production of corn is expected to be high, especially in this planting season. So do watch out whether the technical rebound is evident. If not, I think prices are still going to be heading on the downtrend basis for corn market for now. Now, I didn't touch much on wheat. In fact, I didn't cover wheat because wheat itself is a very, it's a very volatile commodity, and wheat is very sensitive to geopolitics. We have seen that during the Ukraine crisis, at the height of the Ukraine crisis, this market went 3 days on a limit up basis. So really, I think wheat is a very volatile market by nature, and the fundamentals of wheat it is a slightly different product altogether because you can't really gauge the overall supply and demand. Despite US is still a very big producer, there's always, in a wheat market perspective, there's always larger producer, especially the Canadian and the Russian, even to a certain extent Ukraine. So these three are will have a very major impact on prices. And now if you look at CME wheat, sometimes it doesn't really dictate much on where the market direction is going to hit. So wheat is a very different interplay here. You can't apply the same fundamental dynamics as to how you analyze the corn and soybean market into the wheat. But having said that, I think in terms of technical per se, you can see that it attempts to make higher highs, but it failed. In fact, the highs are getting lower in terms of prices. So it does tell you that the price direction seems to be indicating to you it's going to be a short-term downtrend, and it's fair enough because I think wheat, if you look at production wise, especially from the Canadian guys, I think they are going to be producing much more wheat this year, because prices were actually quite attractive last year. So there's still margins to be made. I think wheat market is still going to be facing a lot of pressure when it comes to production wise. Now, soybean oil, I think off late offtake is recently has actually been very good, because I think the supply of soybean has actually been gaining strength, also compensated by the demand for soybean has actually been quite robust. So whenever you have a situation where you have excess supply in the market, coupled with strong demand, you should see prices going up. So soybean oil, technically you can still see that the short-term trend is still an uptrend market. Is well supported above the 50 and 200 period EMA lines. Now, just going to touch a little bit on Heiken Ashi. So I'm just going to show you these two particular chart here, chart A and chart B. Now, if you're a trend trader, normally you prefer to trade on chart A. Now, chart A is basically your Heiken Ashi candles, and chart B is your normal Japanese candlesticks. So the major difference between these two is that you can clearly see that the price gaps are usually represented by the color bar in the Heiken Ashi chart. You can't see any gaps in Heiken Ashi. It usually be represented by the bar itself. Now in Japanese candlesticks, now obviously you can see the price gaps. So if you are using gap analysis or price gap analysis, you can't really use Heiken Ashi. You have to convert back into your normal Japanese candlesticks. Now, one reason why Heiken Ashi is commonly used, especially for trend trading, is because it does indicate to you trend formation, or trend candles quite persistently. So if you are holding to a particular trend, you can hold it to a trend until the color of the trend or the body of the candle starts to become smaller. So when the body of the candle starts to get smaller, it usually tells you the trend is probably going to be weakening, or there's a possible change in trend direction. So Heiken Ashi is good in identifying short-term trends in the market. So major difference, I think Heiken Ashi is really talking about trend continuation. So if you are using Heiken Ashi, you try to identify trend, it shows you in a clearer manner. Now, Japan's candlesticks is all talking about configuration patterns, which most of the time is more to trend reversal. So, and Japan's candlesticks has so many different patterns. Sometimes it may get very cumbersome. While Heiken Ashi, there's only 3 distinct patterns that you need to know. Now, as I mentioned earlier, price gaps, if you are doing gap analysis, you can't use Heiken Ashi because usually it represents the gap by the color of the body bar. So really it's all depending on your trading style and strategy. But if you're a trend trader, I think Heiken Ashi is a great tool for you to use, and for you to establish, especially when you try to identify trends in the market. So these 3 distinct patterns. Now, as long as the color of the body, especially for a green body bar, you only need to see an upper wick. That tells you that if you see this type of body candles in Heiken Ashi, it's telling you that this uptrend is actually very strong. Vice versa, you start to see red candle with a lower wick, it's just telling you that this market is the downtrend market is actually very strong. Now, when you start to see appearance of upper and lower wick, it does tell you that this particular trend is starting to face a bit of weakness. It's not indicating to you possible change in trend, but it does indicate to you that this particular uptrend or downtrend is facing a bit of hindrance, or the strength of it is slowly weakening or fading off. Now, when you start to see the body almost like a dodgy type of candles, that's where it gets a bit more interesting, in the sense that if you're holding on to a certain positions, the moment you start to see body of the candle starts to get smaller, it does indicate to you that pretty much the trend is exhausted, and is actually heading for a possible change in trend direction. So it's important by looking at the body bars and the appearance of the wick, it does tells you whether the market is going to face possible trend extension or is going to face exhaustion in the trend. And it's important to identify at which particular point in time. So this is a sample of it. You can see that this series of red candle bars is a very strong downtrend in this particular point in time because of the appearance of just a lower wick, and the body of the candle bars are actually very wide. So when you have a white red body bars, it's telling you that this downtrend is actually quite aggressive. So just to show you the dynamics of it, red color candle bars is just telling you it's a downtrend market. Green colored body bars with a white body is telling you it's just an uptrend market. If you see a series of green and red with small body candles, it's telling you that this market is heading to no direction. So during this time, if you try to use trend trading strategy, you tend to get a lot of whipsaw signals. So during this time, if you're holding on to a long position, usually it's a good time for you to be out of market, because normally that uptrend is slowly facing exhaustion at that point in time. Now, just looking at Heiken Ashi may not be sufficient. If you pair that with a moving average crossover strategy, whereby you take a shorter term and a longer term, you pair it together, you get so-called pretty much a good signal, a good indication as to when the change in direction for the particular trend. So right here you have red Heiken Ashi bars formation, and together with bearish crossover and moving average, which means bearish crossovers, when you have the shorter term crosses below, is telling you that the market is generally quite bearish. And in fact, it can confirm that with red Heiken Ashi candles formation. Now, right until when you start to see the candles are getting very small, the bodies of the candles are small, it does tell you that this downtrend is starting to face exhaustion. Same goes for here as well. Now, I don't want to touch too much on DMI. I think the key part of DMI as a trend tool is more of the ADX. Now, DMI, there's three different lines. We have the positive DI, the negative DI, and the third line, which is the most important, the ADX. So, if you just if you compare DMI and your moving average crossovers, if you just look at this bottom panel here, the minus DI is your red color line, your positive DI is your green color line. So you can see that the strategy itself to indicate a crossover is actually very similar to a moving average crossover. So there's an overlap in terms of signals. So this is always a choice whether you just want to stick to your moving average crossover, or you can just use the DMI trend tool to determine your crossovers, especially when you look at bearish and bullish crossovers. So DMI crossovers are also very simple. The moment the red color or negative DI crosses above, it does indicate to you the negative momentum is actually very strong. So same goes for here. And the moment when positive DI, the green line crosses above, it does indicate to you that the positive momentum is actually, price momentum is actually quite strong. So in a sense that it's actually overlapping with your moving average crossover. But what is more crucial is that in DMI there's a third line called ADX. Now ADX is a measurement of strength. So it's based on the number. So it ranges from 0 to 100. So every time there's a rule of thumb, every time an ADX goes above 25, it does indicate to you that the market trend formation is starting to gain strength. Anything that's below 25, there's no clear trend direction that's in place. So this is a rule of thumb. You can probably use it. So what you have here is this indication here, the black line here, which is your ADX. Now, notice this: the moment when it starts to cross above 25 for the ADX, you can start to see that the bullish momentum starts to gain strength. And when ADX starts to get flatter, it does indicate to you that the candles are starting to, or rather this uptrend that is seen in the short-term basis will start to lose its strength. Because ADX is a measurement of the strength of the trend. So if you're holding to a long position, when you start to see ADX starts to get flat, that usually be a good indication that the market is going to move from an uptrend, possibly to a sideways market once the ADX starts to get flatter. So always look at opportunity when the ADX starts to cross above the 25 mark, just to show there's the strength, that there's a potential strength in the particular trend that's forming in the particular direction. Now, so this is a particular example of a sovereign market. You can see that despite we are seeing a bullish crossover on your Heiken Ashi and the green color Heiken Ashi bars, you can see that ADX are not rising. It's just pretty much telling you that this uptrend is probably not going to have a bit of strength. Until then, when ADX starts to cross above 25, then it does indicate to you there's a potential entry in the market where the market can hit even higher, and the uptrends will have a bit more strength in that regard. Now, last but not least, I think it's important once you have established a way for you to navigate the market by looking at how to set up entry strategies going forward. It's highly important also to make sure that you have a way to exit the market when it's possible. So, one of the ways you can use is look at average true range as the true range of the particular period. So normally, if you look at ATR value, it comes with a value. So in this sense, you look at soybean markets, this is looking at 3 cents or $3. You can see that, that will be your ATR value. And this particular point in time is, if you look at ADX, is actually rising. So it does indicate to you that this uptrend potential is actually there. Now, why is this uptrend? Because you can see the green formation Heiken Ashi bars and the body of candles are getting wider. And there's a bullish crossover on that. So this will be quite a good entry strategy that you can use to possibly enter a long position in the market. Keep in mind the ATR value is for you to measure your profit target and the stop loss level. So how do we do that? So for example, if you just look at a long entry at soybean at 10.52, your ATR value is at 3. If you work on the risk to reward ratio of 1 to 2, you're looking at willing to risk 3 points and looking at a target profit of 6 points. Now, risk to reward ratio is very individual. There's obviously certain individual who prefer higher to risk to reward ratio, or certain individuals who prefer lower to risk to reward. So it's very individual in that sense. But ATR gives you a good indication as to how do you manage your target profit and stop loss level accordingly. Now keep in mind, ATR values will tend to fluctuate with market volatility. So when markets gets more volatile, your ATR value rises. So in that sense, you have to prepare, to buffer a bigger amount of risk, especially when markets are more volatile. Now, another example, this is again on soybean market. This is a short example because you can see the formation of red Heiken Ashi bars, and the key thing is that the candle bars are forming, or rather is well resisted by the moving averages. That means it doesn't really break both the moving averages. So this downtrend is actually quite persistent. An important indication is that the ADX is also rising above 25. So it does tells you that probably there's strength in this downtrend. And ATR is actually based on is actually 3. Now notice this ATR also starts to rise. So when ATR starts to rise, normally markets are more volatile when there's a possible trend in place. So really, I think ATR also helps you in a way to gauge whether the market is going to be moving from sideways to a trendy market based on the value of the ATR. So here you can take an example. You took a short entry at 10.57. Your ATR value is at 3. If you work on a risk to reward ratio of 1 to 2, you are looking at to risk 3 points with a target of 6 points as a profit. And that's how you set or measure your stop loss levels and your target levels accordingly. So I think that's pretty much on the technical perspective. So I just want to share, some of the contracts available on CME. Now, if you are new to grains market, I know that's pretty much a lot to fathom, to comprehend in a short period of time. But really, I think opportunity is there because right now CME also introduced a lot of micro products. So in that sense, if those days the margin to trade these products are actually quite it can be quite substantial because of the size of the contract. But the introduction of micros are making things easier. So if you just look at micro soybean and micro agri products under the CME exchange, you can see that the margin to maintain one contract is roughly about 180 to 200 US dollar per contract. So it's a matter of how you're going to size up. But I think with such a small contract, it actually makes it easier for you to gain access into the agriculture products. Now even we have a micro soybean oil, which is about the average margin is about 150 to 180. For the latest margin, you can always consult Philip Capital representative. They can give you the latest margin accordingly. So with such a small size contract that's available, I think it gives you a lot of opportunity to actually start your journey. Start to try out on some of the key agriculture products that's available on the CME exchange. Now, in terms of, since it's a new product, a lot of questions will be asking, is it liquid enough? Is there volume? Now, this contract started, I think, in the third week of April. And subsequent days, you can start to see the first few days the volumes are actually quite limited, but over time you can start to see that actually volumes are picking up. Right now on average you're doing about 1,000 to 1,200 lots on micro soybean oil. So really I think volumes are starting to pick up, and the contract itself is actually very liquid. Okay, so just to give you a bit perspective, soybean prices right now is still on the consolidation mode, and ADX is still below 25. It does indicate to you there's actually pretty much no trend in place. Unless ADX starts to rise above 25, then we start to see that there's probably trend formation that is coming. As for corn, really, I think the short-term trend is this uptrend. The short-term uptrend we see is probably not going to last because the fundamentals are still quite bearish. But let's watch. I think as long as it doesn't break or it face resistance at the 50 and 200 period EMA, it's going to head further down south if it can't break if it can't break any of the moving averages on the upside. Now, soybean oil, it gets a bit more interesting. If you just look at the action last week, mainly because of the EPA announcement, you can see that that there's a big drawdown in terms of prices. But I think it will quickly rebounded because the oil price is actually supporting the narrative, the positive narrative of the biofuel segment. So, and short-term wise, you can see that the rebound is putting a bit of support for the soybean oil market, and therefore 47 cents level is usually is a key crucial support level to watch. So with that, I'm just going to end here. I'm just going to hand it over to Charlie for any questions from the audience.
Yep, thank you, Mr. David. So, if you all have any questions, please feel free to submit them in the question box, and we will have Mr. David to address them. And also, thank you, Mr. David, for the insightful sharing. We appreciate the information you provided just now. Yep. Feel free to submit your questions. All right. Okay. So, Mr. David, there's a question. May I know how much margin to trade? But he didn't mention specific product.
Okay. Okay. If you just look at I mean, hopefully the question is referring to micro. The micros are the margins are very small. On average, you're looking about what 150 to 200 US dollar as a margin. Now, I don't have the latest margin. Perhaps maybe you can talk to any of the Philip Capital representative that can give you the latest margin. But I think on average, the margins are between 150 to 200 US dollars for one contract.
All right. Thank you, Mr. David. Okay, that's a question like she don't understand how get the number of ADX3 and to apply it for the profit target.
Okay, ADX and profit target. Okay, just to clarify, ADX is not used for profit target. The ATR value is used for profit target. So, for example, if let's say the true range, average true range for the particular day is 3 cents, or the particular period is 3 cents. So you're looking at if you're looking at risk to reward of 1 to 2, that means you're willing to risk 3 points 3 cents, and you're looking at 6 points or 6 cents as your target profit. So that's how you use your ATR value to determine your profit target and your stop loss level. Now, ADX is a different measurement. ADX is looking at the lines. So anything that's above 25, ADX value is telling you there's trend in the market. Anything that's below 25, that's tell you there's no direction in the market. It's non-trendy market, so you can't use any trend strategy. So ADX measures the strength of the trend. ATR helps you to measure your profit target and the stop loss level accordingly. Yeah.
Okay. Um, So one more question is, are there any websites to refer to regarding the important reports that affect soybeans and corn prices?
Okay, that's a good question. The best website you can go is either the CME website. They have plenty of resources on the latest, crop report, or even USDA. Now, if you find that all these are very tedious, I believe Philip, as a service, they also offer to their clients reports, daily reports, or even weekly reports. So I think those are also sufficient for you to gain a bit of understanding on the fundamentals of the market.
Okay, so due to time concern, maybe we just go for a last question. How do you anticipate shifts in global soybean demand, particularly from China and India? Will it impact pricing strategies over the next 5 to 10 years?
Yeah, definitely. I would say, China is still very dominant. Now, India to a certain extent, they are also quite a big demander of soybean, but it's not as much as, as to what, China is demanding. China is a very big player. Now, would there be a shift in terms of their dynamics? I would say it will be in foreseeable years. We probably will see demand pattern shift in China as to the dependence of the U.S. soybean. We have seen data. I've shown you the chart. U.S. soybeans, China dependence on U.S. soybeans is slowly getting lesser and lesser. And with this trade war that is ongoing between U.S. and China, it's going to push them to put more reliance on the South American players. So, but that having said that, that never changed the equation. I think China will still demand a lot of soybean going forward because of the population growth. There's a population demand for it. So really, I think there's the dynamics will shift in terms of US supplies to China. So going forward, you probably will see less US supplies going into China, and US definitely have to look at other markets. Whether it's going to be India, extra supplies covered by India, that's really backs. Is much to be seen, but I think as regards to US and China, China will slowly put less dependence on the US beans. That's for sure.
All right, thank you, Mr. David, for answering all the questions, and also thank you all for submitting the questions. And now we'll move on to our touch and go reload pin giveaway. So before that, I would like to explain how this works. So how can you win is very simple. Once the question is released, the first person to answer correctly in the question box will win a touch and go reload pin worth 50 ringgit. So here's a gentle reminder, each person is only eligible to win once. So we'll have four different winners tonight. Alright, so without further ado, let's hand it over to Mr. David for the first question. Good luck, everyone. Mr. David, please
Okay.
announce your first
Yeah,
question.
sure. Yeah, so hopefully in a past 1 hour I've been sharing. Hopefully, some of the audience do pay attention. So I'm going to start with the first question. So the first question is going to be, which month of the calendar year does U.S. corn will start planting? So I repeat again, which month of the year the U.S. corn will start planting?
Okay, so yep, we received few responses, and the first one who got the correct answer, which is April, is Yi Pei Lim. Congratulations to Yi Pei Lim.
Okay, well done. So I'm going to move on to the second question. So listen carefully. The second question is, which monthly grain reports that is watched closely by traders? So I repeat again, which monthly grains reports that is watched closely by traders?
Yeah. So yeah, there's so let's see who wins this question. Okay, so the first one who got the correct answer, which is WASDE, the World Agriculture Supply and Demand Estimate Report, is Tay Ernest. Hey Ernest, congratulations, you just won 50 ringgit touch and go reload pin. And yep, okay, so thank you, Mr. David. I will continue for another two questions. So the third question will be, what is the active month of CBOT micro soybean oil for now? So what is the active month of CBOT micro soybean oil? Okay, so the correct answer is July. So the first one who got the answer correct is Pei Hong Kor. Congratulations to Pei Hong Kor. And now we come to the last question. So it's a very easy question. So what platform we use for futures trading? So the platform we use for futures trading. All right. So the first one who got this correct is Woon Li Fen. Congratulations to Woon Li Fen. All right. So after this, we will have our person in charge to contact you via email, and please bear us some time to purchase the pin and send it over to you. All right, congratulations to all the amazing winners and to everyone who participated, whether you won or not. Thank you so much for joining in. We truly appreciate your participation and support, and we love having you with us. Okay, so before we wrap up, if you're interested in opening an account with us, feel free to scan the QR code here to reach out, here to open an account, or you can just reach out to us after the event. And if you would like to dive deeper into futures or stocks trading, you can also request for a private coaching session to get personalized guidance. And yep, we'd love for you to stay connected with us. So you can follow us on Facebook, Telegram, LinkedIn, Instagram, and TikTok for the latest market updates, promotion campaigns, and event announcements. You can also subscribe to our YouTube channel for educational videos and visit our website for more information. So we do have two Telegram channels, one for stocks and another one for futures and CFDs. So you can scan the QR code to join our channels. And yep, here's the contact information for all of our branches. You can reach out to us via phone, email, or just simply walk into the branch. Yeah, you may take a screenshot for the contact details. And yet, with that, we have come to the end of our webinar. Thank you everyone for being here tonight. We truly appreciate your time and we hope you found the session valuable. Also, a big thank you to Mr. David for his excellent presentation. We
Thank
hope you
you.
all enjoyed the webinar and yet we look forward to seeing you at our upcoming events. Thank you everyone and have a wonderful night ahead. Thank you, Mr. David.
Thank you. Thank you.